What's up, everybody? Welcome to the View from Jamestown podcast edition. This is episode 49, and this morning we are sitting down with Robert Fry. Morning, Robert.
Morning, Ben. It's a pleasure to be with you this morning.
Great speaking to you too. How's everything going this first, 12 days of the new year?
Well, I think economically we're off to a slow start, but I haven't had to shovel any snow yet, so I count my blessings.
Yeah, we had one good storm up here so far. I think we got a good maybe 6, 7, 8 inches, but it's all green out there now, unfortunately. But we appreciate you taking the time and sitting down with us this morning. Obviously, we had Robert Fry as a company presenter last week at our quarterly virtual sales meeting, which was available to obviously all our customers and suppliers that were registered on our email list. So, we thank you for that presentation. That's some great feedback. It was really great information, especially to kick off the year. But I think just getting started, I'd love to get a brief, bio on yourself and your background, as well as, the business Robert Fry Economics and what you're doing today.
Well, right now I am chief economist of my own company, Robert Fry Economics, LLC. I started that in August of 2015, a month or so after retiring from DuPont. I was at DuPont for more than 30 years. That includes about 2 or 3 years with Conoco at the front end and a few months with Chemours on the back end. But I left there in the middle of 2015, started my own company. I publish a monthly newsletter on the economy called Current Economic Conditions. It's very similar to a newsletter that I wrote for DuPont and its employees and its customers for more than 20 years. And I sort of enjoyed doing that. So I started my company in part so that I could keep doing it. I have many subscribers that got my DuPont newsletter that are still getting my Robert Fry Economics LLC newsletter now. I also give speeches on the economic outlook to corporate leadership teams, to customer and supplier events like the one we did last week, and also for trade association meetings. So that's basically what my business is, and I've been a business economist since I finished graduate school in August of 1984.
Very nice. Yeah, I know obviously you gave the speech to our company and customers last week. It was excellent. And I know a lot of our sales teams either worked, for DuPont and heard you at that time, or have seen you at various trade organizations. So yeah, it was a great presentation, and we're happy to have you on the podcast this morning. And I think jumping right into it, we'd love to kind of get your overlook or outlook, or maybe recap of kind of 2020. I'm sure it was certainly an interesting year from an economic standpoint. I know everyone was affected by it in various ways. So yeah, I'd love to get your viewpoint or opinion on 2020. What happened, if there was any anything like that, any 8 or 12 month period like that in the history from an economic standpoint. Give us a recap from your eyes on 2020.
Yeah, well, 2020 started out well. The first 2 months we had strong employment growth. Looked like the economy was picking up, and then the pandemic hit about the middle of March, and we suffered the worst recession since the Great Depression. It was also the shortest recession since the Great Depression. It was, probably go down once the histories are written as 2 months long, maybe 3. There was a business cycle peak in February, and the trough was probably in April, certainly no later than May. But the second quarter decline in real GDP was by far the biggest ever. And we've been recording quarterly data since shortly after World War II. So we might have had a worse quarter during the Great Depression in the late 20s and early 30s, but we don't have any quarterly data to prove it. So since we've had quarterly data, this was the second quarter last year was the worst quarter by a factor of 3. The decline was more than 30% at an annual rate. And until then, the worst quarter we ever had was in 1958. It was minus 10% at an annual rate. Had a nice sharp bounce back in the third quarter, at least in annualized growth rate terms, more than 30% on the upside. But if you know your growth rate math, you know if you go down 30% and come up 30%, you don't get back to where you started. So even after that third quarter rebound, we were about as far below the pre-recession peak as we got at the very bottom of the Great Recession in 2008 and 2009. So last year, despite the bounce back at the end of the year, it was the worst year we've had in terms of annual data since 1946 and the immediate wind down after World War II.
And is it safe to say at that very bottom, whether that was late March, late April, that nobody foresaw it bouncing back this quickly? I think that was maybe the scariest part of those couple months is, okay, is this going to be a 2-year thing? Is this going to be, no one knew what was going to come, and I don't think anybody expected maybe it to bounce back as quickly as it did.
Yeah, I'm in the process of drafting my January newsletter, and one of the things I'm talking about is how the bounce back has been stronger than I thought, and I think stronger than most economists believe. And I think there's 2 reasons for that. One is we got a lot of fiscal stimulus last March. I think the people that passed it are going to put the emphasis on the size of the stimulus. I would put the emphasis on the speed. There's an old joke in economics that the recession is over when Congress passes a stimulus package. And because historically they never got it through Congress and got it enacted until after the recession was over. Last year was very different. They reacted very quickly. You have to give them credit for acting so quickly. So they got a lot of money into the economy, and that helped things bounce back. But it's not all policy. I think the natural resilience of the economy was stronger than we thought. And what I mean in this particular case is we've been able to shift resources and spending from activities that can't be done safely to those that can. So while spending on bars and restaurants and a lot of services is still way below its pre-recession peak, consumer spending on goods is actually higher than it was before the recession, and that's a big surprise. So people who can't go on a trip, who won't go out to a restaurant, they're saving the money that they would have spent on travel or dining, and they're spending it on improving their homes or buying goods and having them shipped to them. And so you had a stronger bounce back on the good side of the economy than we expected. We've also seen a very nice rebound in the housing sector. Housing is much stronger than it was before the recession. And that's a combination of 2 things. One, people want to get out of the crowded cities and living in apartments and get into a single family home out in the suburbs or the exurbs. So that creates the demand. But on the supply side, when you're building a home, you're not closely crowded together. That can be done safely. People are usually separated by 8 feet by the length of a 2x4 or the length of a sheet of drywall. So people who are building homes, they can do that safely. Some of them probably are used to wearing masks. Same with most of the manufacturing sector, except in industries where people are crowded together, like meat packing or maybe the garment industry. In most of manufacturing, people are spread out. They can operate safely. Again, they're used to wearing masks and other PPE. So manufacturing has bounced back. Now, manufacturing is not all the way back to its pre-recession peak like housing is, but it still had I think a stronger rebound than most people expected. And I think a lot of that is just due to the fact that we've reallocated spending towards safe activity and reallocated at least some labor towards safe activities.
Yeah, I can attest to that. We ended up buying a house. We closed in early November, so we were on the house search during the peak of kind of COVID coming, or the economy coming back post COVID, and can attest to how strong that housing market was. It was a crazy search. I think it's still going to be like that here coming into the early part of this year.
Yeah, and it could be stronger if there was more inventory, but a lot of people don't want to put their houses on the market, and so the inventory of existing homes is at record lows, and there are restraints on building new homes, due to a lack of laborers or land, or shortages or high expenses for lumber. So we can't build homes as fast as we'd like to meet the demand. So consequently, since demand has risen faster than the supply, you've seen home prices rise quite a bit.
Absolutely. So, and I guess where does that put us today? So, is it safe to say we're clear and out of the recession? How does the current economy look, compared to obviously the worst in COVID? Where do we stand today based on coming out of 2020?
Well, we had that strong rebound in the third quarter, went into the fourth quarter with a pretty good head of steam. Lost some momentum in the fourth quarter. Some of that was due to the to some of the stimulus from earlier in the year running out, and some of it was due to simply a rebound in COVID cases. It rose in the fourth quarter, a response to people going back to school. It rose some more after Thanksgiving. It rose some more after Christmas. So I think you've seen the good sector of the economy, the restaurants, fall back down again. So we actually saw employment decline in December. We could see another month or two of that. But I think as you look towards the horizon, things get better because they're rolling out a vaccine. Now, it hasn't gone as smoothly as people would have liked, but the vaccine is there, and as people get the vaccine in their arms and the second vaccine, they will feel much safer resuming their normal activities. So I think you will see a pickup in restaurant traffic, in airline travel, in people rejoining the gyms perhaps, although the people that have bought a nice Peloton or high-end treadmill and put that in their basement might not go back to the gym quite as fast as people go back to airlines and restaurants. But I think that happens over the course of the year. First quarter, I think, is going to be kind of weak because of the pickup in COVID cases. But as I look to the second, third, fourth quarters, I think those are going to be very strong quarters that will get us back to the pre-recession peak probably by the end of this year in terms of GDP and industrial production. I don't think we get back to the pre-recession peak in terms of employment until well into 2022.
Got it. And I know one thing that we as TCC closely monitor, and I know a lot of our customers and various manufacturing facilities and capabilities are keeping an eye on, is China. Certainly something that's an interesting topic, pretty much no matter, I think, regardless of the industry that you're in or the types of products you're producing, whether that's things being produced in China, raw materials coming from China, and products ending up shipping back to China. So what's the current status on China in terms of the U.S. economy, and what are we seeing? How do we see that impacting 2021?
China, because in a totalitarian society, you can enact restrictions that you can't in a democracy. They were able to squash the virus much more effectively than we were. They had two bad months, January and February, where industrial production basically collapsed. But they rebounded very quickly and are now well above pre-recession levels. Now, I did read something yesterday. There's a large city near Beijing that's under lockdown now because they've had a pickup in cases. But for the most part, China has dealt better with the virus than the U.S. or Western Europe have. So if you look at their relative strength economically, they've gained on us during this pandemic, and that may be true militarily as well.
Yeah, something we'll keep a close eye on. Certainly, obviously affects our business in a bunch of capacities. I think one of the biggest things that we've still seen, at least in the U.S., is that 25% tariff still in effect on a lot of raw materials that are coming in from China. So we've seen those raw materials going other places like Mexico and Latin America. So it's been an interesting global supply dynamic in that function.
And one thing to keep in mind that before President Trump, the Democratic Party was the protectionist party. So just because President Trump is leaving office does not mean that those tariffs are going to disappear right away. I think President Biden will use those tariffs as leverage and is not going to be in a hurry to get rid of them. So those of us who may not like those tariffs might have to wait for some relief.
Yeah, absolutely. Obviously, a lot of this trickles down to specifically the TCC's business. A lot of markets or functions that our customers and suppliers are acutely, a part of, whether that's wire and cable and paints and coatings. I know you briefly touched upon those industries in our presentation last week, but what's kind of the outlook on both the wire and cable market and then the paints and coatings market? Do you see strength coming back in those two?
Yeah, well, the wire and cable market, at least in terms of industrial production in the U.S., has regained less than half of its recession losses. So it's got a ways to go yet. I guess if you want to look at that as a glass half empty, wow, we've only gotten back maybe 40% of the decline. If you look at that as a glass half full, oh, we got plenty of room to grow over the next, 9 months to a year. So I would expect that to continue to rebound. As far as paints and coatings, it's very interesting what the industrial production data show. They show a big decline in the recession, just as most people would anticipate, but very little rebound. And the thing I ask is, well, don't a lot of paints and coatings go into houses? And if we've got this booming housing market, aren't they painting these houses? And a lot of other paints and coatings go into the auto industry. And yeah, auto production is a little bit below where it was before the recession, but it's pretty close. It's to being fully recovered. So this is suggesting to me that unless people are living in houses that aren't being painted and are driving cars that don't have any paint on them, this looks like an inventory depletion, and production is going to have to come back in order to replenish those inventories and meet the demand for painting homes and cars.
Yeah, that'd be, I guess, my next thought is to both the wire and cable and the paints and coatings markets obviously do directly impact the automotive market, which is something that I think was hit as well in 2020. And I think we've at least seen some initial numbers saying that the automotive market is coming back, if not, close to pre-recession numbers, as you mentioned.
Yeah, it had been running in terms of light vehicle sales. It had run at or slightly above 17 million for 4 years. And, of course, it's much less than that last year, but it's up to better than a 16 million seasonally adjusted annual rate as of December. So it's gotten most of that back. That's another part of the economy that bounced back faster than we thought, because people did not feel safe taking mass transit. The last thing you want to do during a pandemic is get in a metal tube with a lot of other people. So you had strong demand for vehicles. A lot of that was strong demand for used vehicles, and you saw used vehicle prices rising very sharply. But you can't buy a used vehicle unless somebody trades it in on a new vehicle. So that generated demand for new vehicle sales as well. So that's been a positive surprise as well. Not quite as big a positive as housing, but it's still been positive.
Yeah, it seems to be an interesting byproduct of obviously the COVID pandemic's obviously, horrible, but an interesting byproduct of everything that's happened over the last year is things like the housing market strengthening, automotive, purchases strengthening. I know I've got friends that live in cities that historically just walked or took public transit, and now they all have cars or have moved apartment buildings so that they can get free parking. So it's been an interesting, kind of maybe unexpected piece of the back end of this pandemic here.
Yeah, that's the biggest difference between this recession and recovery and prior ones. In most recessions, there are few, if any, winners. Everybody loses. In this case, there have been a lot of big losers in terms of restaurants and gyms and travel, but there have been some winners. We talked about housing. That's a big winner. Any kind of software that allows you to work from home, that's a big winner. Retailers, either big box retailers that were able to stay open when smaller retailers were forced to close, they're winners. Those that sell online like Amazon, they're winners. So it's very different from past recessions when everybody lost. There have been some companies that have gained from this, and then others that have lost much more than in a normal recession.
Yeah, and so that brings me to my sort of final bullet point here. As I'm sure you get asked all the time to pull your crystal ball out and tell everybody what's going to happen, over the next 6, 12, 18 months. What's your outlook for 2021 and 2022? Is there anything major coming up, or events that you see happening, or things that may, greatly impact this year, or what's kind of your general outlook for the coming year?
As I said earlier, I think the last 3 quarters of this year, we're going to have strong growth. Because we've outperformed what I expected, I think we get back to what economists call potential GDP sooner than I thought. And potential GDP, one definition they use for that, is the highest level of GDP you can reach without inflation accelerating. Well, if we're going to get back or go above potential GDP sooner than I thought, that means inflation starts accelerating sooner than I thought. I think we start getting some more inflation probably next year and the year after. One of the things that if you look at inflation over the years, you notice there's a lot of inertia in it. It takes a lot to get it to pick up, and it takes a lot to get it to slow down. So it'll take a while before it really heats up, which will keep the Fed on the sidelines and keep interest rates low. But if we get the kind of growth I'm expecting the last 3 quarters of this year and maybe into early 2022, we're going to get some inflation somewhere down the road. The positive scenario is maybe potential GDP is higher than the Congressional Budget Office thinks it is. So we get all this stimulus this year, the $900 billion we just got, and maybe some more that President-elect Biden is talking about. I'm thinking that just rams us up against potential GDP sooner and causes higher inflation. But if potential GDP is higher than we think it is, that just means we get stronger growth and that lasts a bit longer, and maybe the strong growth continues into 2022. I'm hoping that's the case. That's not my forecast right now, but I think it's something we need to consider. The other thing to keep in mind is the difference between quarterly growth rates and annual growth rates. Because growth slowed in the fourth quarter, and I think will be slow in the first quarter, that's going to put some downward pressure on the annual growth rate for 2021, but I'm still looking for something between 4 and 5%. So it'll be the best year in quite a while. But those 3 strong quarters at the end of 2021 are going to keep that annual growth rate high in 2022, even if the quarterly growth rates slow during the year. So we're still going to get a strong above trend annual growth rate in 2022. So if you're making plans based on annual numbers, you need to keep that in mind, even if you think the economy is going to slow on a quarterly basis.
Yeah, it seems like the optimism is good for this year. I think that was a definite theme from your presentation last week and some of our discussions later on in the day, that there's definitely optimism for the coming year. So, hopefully all signs point towards, a positive year, and definitely a better year than 2020.
Yeah, I think it's going to be a better year than 2020, and I think 2021 is going to end a lot better than it started.
Awesome. Well, I appreciate the time, Robert. It was great talking to you. Maybe if you want to just tell, we'll put some links here in the show notes, depending how you're streaming this. If you scroll down, we'll make sure we put some links and contact info in there. But maybe you want to just let people know where to find you, or how to contact you.
Yeah, you can find out more about me and my company at robertfryeconomics.com. You can email me at robert@robertfryeconomics.com. If you like, I'll send you a copy of the December issue of my newsletter and let you know how you might subscribe to it going forward.
Yeah, that'd be great. We really appreciate it. Really appreciate your presentation for our company last week, and are excited to have this episode come out. And maybe we can circle back early 2022 and see how the predictions came, how the year ended up, and touch base maybe then.
Yeah, hopefully you'll think next year you'll look back and think I was too pessimistic.
Hopefully. Once again, thank you. We appreciate your time. Great speaking to you. Appreciate your insights. As mentioned, we'll link up the Robert's contact info and website here in the show notes. Thank you again, and we'll speak to you soon.
Thanks, Ben. Appreciate it.